Everybody, this is Chrissy from Solstice ATR. Hope everybody's doing great. What I'd like to go over is a couple of things before we get started. Is the stock market bells ringing? What I mean by it, are bears around the corner or the bills having a red flag on the tape and the charts in front of us? Since February last year, 2020 till March 23rd, 2020, we had a decrease in the market. Then we rallied all the way till December. And now we're having a small minor correction. Is inflation around the corner? Is the Federal Reserve Board able to keep this market up by pumping more stimulus into it? Is the $170 billion that's going to be given to the economy, part of it going into the stock market? And I will go over it in a little bit in detail. And since everything is, the vaccines is out, are people going to go back to normal, or some of the cities are broken or not? So we will take a look at the futures, the Forex, the Bitcoin, the metals, the bond market, the yield, crude oil, some stocks and ETFs. Remember, I am not, trying to predict whether we are bearish or bullish. You have to be open-minded to both sides of the market. And people's opinion do show in the charts because people's have emotions and feelings and psychological. So before we start, for illustration use only, we're not a broker dealer. Past performance doesn't indicate future results. Use at your own risk, and data may not be copied. Okay, let's first of all take a look at the combination of the four instruments. I haven't done it for a while. As we can see here, I got the S&P 500, the Nasdaq, the Russell, and the Dow. This is the major exchanges on the New York and the Chicago, showing the overall stocks in the market of the 500, the Dow 30, and the Nasdaq 100, but it does not represent the mid cap, the values, the Russell 1000, or the different, value play mid cap, as well as, consumers products and all that, because all the tech sector has been pushing very hard. Is there rotation from the Nasdaq to some other instrument? Possibility. I'm showing here a 6-month chart instead of a year, because I want to make sure that you understand the combination of the four. We do have a small gap here. You can see I marked it with an oval. This was the prior breakout. We had one before beginning of the year. This is the second one, the third one, and we rallied higher. We are testing the 50 simple moving average due to a little bit of weakness. We are inside of a linear regression channel. I still have the 89 EMA right there. I have this 38.2 fib right there from high to low on the last 6-month range. I know that this was the breakout before the consolidation. Are we going to come back and retest this area in the 116? Possible, but make sure to be open-minded that we can, have a variety between, 20 days all the way to about 100 days volatility on the short term. Can we have a decrease of a 4%, 5%, 6%, and even 12 or 13, 14% decline? Yes. Is it possible on the short term the market looks not as good as on the long term? Because if our outlook for 2 to 5 years outlook, we will have a better, outlook on the market as a investor than a day trader. Day trader look at the short time frame. Remember, most of my videos you see me just talking about the short time frame, not the long time frame. It's going to vary from person to person's time horizon, midterm, and long term as well. So let's start by breaking this down step by step. So what I want to do, take the NASDAQ first. This was the weakest out of the whole pile, and I'm going to use the E-mini contract. I have narrowed this to a 1-month fib and an annual fib. As you can see, the prior high was over here. Before we broke out, we created a W and we eventually rallied up. If we consider this is a shoulder, this is the head of it, are we going to create a shoulder? We are underneath the 50 simple moving average. We broke the linear regression channel heading in a downtrend. I have an open cone heading south. This is the weekly fib from high to low. What I can do is zoom in. This is the annual high for the year. We are below the annual high on the NASDAQ. I do have the 116 SMA here. the 50 and the 61.8. Even if we come back to this area, we still would be bullish, but be open mind to change. Has the Nasdaq lost about in the last week or so 6%? Yes, it has. But if we look at it as an overall, are we still trending up? Possibility we are. We may have a small correction, but we may U-turn. We tested the 89 EMA on the daily and reversed back up. But on the Friday at the close, they sold the market a little bit because due to the weekend holding, we retested the breakdown of this big candle. We spiked back up to it. We couldn't hold it and we fell back in inside that candle. We are still bearish. I'm not saying no. We closed right around the, as you can see, 12,905. And what is our annual high for the year? If I put my mouse on it, it'll show you 12,918 and a quarter. So if we go back above that area and continue back to the 61.8, this is a very important area, 13,260, in order to break to continue higher. If not, we fall back down. Let's take a look at now the Dow Jones Industrial Average, which was a little bit more better than the Nasdaq itself, and it looks more healthier than what the Nasdaq is, because this was the W shape. We grinded for a couple of weeks, went a little higher. We retested in February when we fell down, but we're still in an up channel. I mean, I have to fix this channel here. We looked up, the last 2 weeks have been, the last 2 days in the range have came back in. We wiped out like about a week and a half, but we still have 1 week up. We're consolidating in the prior breakout. In order to fall, we have to lose the 50 simple moving average, lose the 50 fib, the 61.8, and eventually retest the major channel, which is up here, which is the uptrend, which plus the 89 EMA will be in this area to go back higher if we fall. If we reverse and go back up, be open mind to change. Don't be biased just to one side, being bearish since the last week or so. Usually when you have more than 2-3 days trending down, usually you get a small reversal, but sometimes it doesn't, and it causes a reaction in the market due to the yield. So that's the Dow. Let's go to the small cap, RTY. As you can see in the RTY has been more healthier since the annual high. This was the annual high. I have it marked over there. We looked up, we came back, retested it in February, and after February, we pushed quite a bit higher. I do have the monthly from high to low from February 2nd all the way up to February 10th. That was the high. We retested, tried to go back up, and on Thursday, Friday, we fell in. We tried to go halfway back into this candle to continue higher, but we had a doji and we closed right at the 50 monthly fib. If we do lose this weekly down channel in the 38.2, this should be, you can draw it the other way around if you want. That would be the 61, that would be the 38. Usually the 61 will act as support, but I drew it down because the month finished, and I'm thinking if the 61.8 we cannot clear it to continue higher, we fall back to the channel, the 50 simple moving average, the prior channel, or eventually to the prior extensions down here. That's on the small cap. Let's take a look at the ES itself. And what I can tell you is the ES is in a linear regression channel, has been in this channel for a very long time. We have not tested as much the 50 simple moving average until the last month, and we retested it down here in November. Then we broke higher, then we came back to it. In order to continue higher, this was the W shape that we had. The annual high is sitting up here. If I put my mouse on it so you guys can see it, annual high is 37,053, and monthly was in March 23rd, 2174. So more or less we are in an uptrend. We have not broken the annual high of last year. If we do not hold it, we got to watch this channel. This is a very important channel here. This is going way back to March 23rd, and we retested it here in you can see in November. We almost retested it here in February, and then we U-turned and came back up. If this time we break, I do have this smaller linear regression channel. I have the 38.2. If we do end up losing more than 4% of the retracement, I will look for 6%, 8%, 10% and eventually about 13% in the S&P 500, which will give me a range of the 37,040 to 3723. And we should usually get a nice rebound because this is a rounded number, the 3700. Sometimes you may wick into it, which let's say you ended up in the 3690 to 88 area and you turn and go back up. That is okay, but it doesn't mean that we are, going to be super bearish because the outlook from, the 2008 till 2009, we had that big drop in reversal in 2009 and we continued higher. We've been running for so long and we had a couple of glitches along the way. The French, the British exit, the trade wars, then now we got the COVID. But since we are in a recovery stage, we may have a little glitches in there and we retested part of the gap, but the full gap we did not fill 100% of it. I need to fix that on the charts. There's a small little gap as you can see at the 73.85 because the low of this was 73.85 and the candle, the low of that is 36.56. So we have a small little area still to cover in case we fall down. We are holding the 50 simple moving average. If we end up reversing, we will look higher, coming back to the 61.8 to continue up. So do not be biased about the market because the trend in the last week and a half, because we had on Wednesday a nice reversal sharp move up. We retested the high, couldn't hold, and we fell back in on Thursday. Friday we tried to recuperate half the candle, couldn't close on Friday up there. They sold the 60 and brought it back in, or the 50, the 38.50. So make sure you trade what you see. Let's go now into detail into BTC and Bitcoin. BTC. Why am I doing this? / BTC. Yeah. Okay. This is my annual chart. It's got a lot of advanced decline line momentum indicator. When the RSI shoots above 75.80 and hits a ceiling, it gives me an extension and a DMI plus ADX advanced decline line compared to the momentum indicator or the CCI. It gives me a higher target every time it shoots it. It gives me a higher label. Then it shoots another one and gives you a higher label. So every time it shoots it, it reverses to the mean. Then it comes back down. So those clouds are usually visited in the future when we go up. When we come back through them, we eventually fall back. There's a couple of major gaps in Bitcoin since those three major moves happened from the 8,000 to the 10, 13,000 to the 20,000, 23, then we broke up. We ended up running to the 24,000, then we gapped up to the 42, came back to the 28, reversed back and continued higher. So we have one gap, two gap, three gap. I don't have the other ones marked in this one. And I've been calling the 54,700. Be careful of it here, gentlemen. Be careful of it on my Twitter for the last week and a half. I've been saying if we do fall below that 45,000, be careful of it. If you're listening to me in Bitcoin, you should have been gone at 54,500. Never looked back because we have lost the 18 simple moving average, coming to a gap. If this annual fib, this is the annual high, you can see I have a marker there. This is the extensions of it. These are the extensions. If I lose that 61.8, I don't think the 50 will hold or the 38. I would look to fill 100% of this gap where the ADX got too extended and the RSI here to fall back in this range in order to continue, because a lot of people consider it as a commodity part of the trading. What I'm going to do is go to a 30-day intraday to show you what we can look at. We're going to go down here. We're going to go, instead of 90 days, I can do 90 and we zoom it in. We do 4-hour chart so everybody can see it. So we can get rid of that so it's more visible to everyone. I do have a monthly fib on the chart. We'll go to the monthly and the weekly and be open mind to change. On the weekly, since we started in February down here, we had this gap here. You can see it in the overnight. That gray area is the gap. We looked up, we continued, we consolidated here for a couple of days. We retested, pushed higher. Eventually, we went to the extreme. We went to the 100% fib, then came back in from the mean to the 23, the 38. If the 50 does not hold, and the annual high 61.8, because they are similar and very identical in compression, and the RSI lost momentum, it's no longer sitting at the high, it's trying to recover, but it has fallen. If this is considered a shoulder, this is the head and that's the other shoulder. If it cannot sustain and go above the 500 or the 600, I think the trend, because the 116 SMA doesn't hold, we will look for partial refill into the 50 fib annual high extension and the 38, and that will give us the gap fill and eventually to the 50 or the 61.8 before Bitcoin can get some momentum back in it, because people see it in the trend, because they can see whether you consider it an electronic commodity or a currency. For me, it is some kind of an electronic currency, but it is not replacing the euro dollar right now. It's not replacing the Chinese money or the American dollar or the Australian dollar. People are looking for an investment vehicle to make money in it, and this is a good example using BTC. Or you can use the ETF. If we look at the GBTC, that's an ETF fund. If you cannot trade futures, you can look at this one and trade that on momentum in GBTC or MARA, M-A-R-A. To give you an idea, gentlemen, how to use an instrument that will allow you to get some ETFs if you cannot trade crypto or you cannot trade the future itself in crypto or Bitcoin. So let's go to GC, which is gold. GC, I know I put it on a monthly chart. Let's just go back and put it on an annual 6-month. Let's just zoom down. And I will show you, we have a linear regression channel from an annual high coming down. We tried to go above that 50 couple of times. We tried to break up. We could not break up, because if the global markets are broken, gold should be the safe haven to move money into it. So if the currency of the dollar getting stronger, or the European currency, or the Japanese, or the Aussie dollar, or the British pound, you have to look at, or the Canadian, you have to look in relationship to the bond market, the gold, as well as the yield in the bonds. So this will keep us at a harm's way not to be biased to one side. If things go south and the Federal Reserve Board cannot sustain the market, then we look at gold for a nice rebound. And what I want to show you is on a 6-month or an annual chart. We can go annually. As we can see, we had this up move. We coming back to retest not just the 50, we lost it. I am thinking because of this major consolidation, this is like the range is between, the 1780, let's call it, and the low of it is around the 1700 or 1692. This is the prior area. We had that that head and shoulder, you can see it, and we eventually broke up. There's two gaps in here in the professional overnight gap since gold moved to the prior high. We have retested this one. This is no longer valid. It's out of the way. As you can see, it's being retested here. Okay, so we went up. We have this gap on the top. We tried to retest and break out. We couldn't. We fell back in. And this is the reason why I'm showing you gold on that 1-year chart. But what I want to do is break this down to 6 months to show you the weekly fib, where we are in relationship to what the market outlook is. We're going to go from a year. We can do 3 months so we can look at it a little bit bigger and much, much cleaner. So as you can see, on the 3-month range, we have we retested the low linear regression channel. We went to the top of it, came back halfway to the 61.8. If you put a middle point, going down this way, you had a mid-range here. We tried to look up to the 38.2 or 61, fell back in, retested that 38 or 61, bounced back up, couldn't hold it, fell back in, tried to go up, and eventually the last 2 days or the last 3 days in the market, you had two dojis and eventually gold fell down. This is our monthly fib from February. This is the high, this is to the low, and we have the weekly high and low. In order for gold to get some momentum back in it, it needs to clear the 1775, 1780. If gold does not sustain the 1700, look for the 1692, if not around the 1675 for a nice rebound, and that will give you the linear regression channel to the downside down here before you get a nice rebound back up. I would like to see gold in this area so I can go back long and trade it back to the mean, to the halfway back in the charts. So I'm not trying to be telling you what to do. This is just my opinion. Do it at your own risk, okay? Let's go look at crude oil, CL. Since the pipelines and since, Biden got elected, the pipelines got cut and some people lost their jobs. So we are relying, instead of being sufficient on oil in the country, in the US, I would rather be our own, production. We are going to rely on Canada and Russia to get oil from out of the country. So oil has spiked from the 50 range all the way to the 63. Is oil maybe coming back to its mean where it went too high to come back further back in order to continue higher? So what I want to do is just show you this area here and see if the fibs are done correctly, because I don't think I've anchored the monthly fib correctly, and I think this is the February. Where is this? February 1st. Okay, what we can do, we can right click here, edit the property, and I usually put them in purple. And what I'm going to do, instead of daily, all these fibs I have here in the extension, we go select, we go to more, and we put them in purple color for the monthly extensions and the range bound forest. So we have the 50 SMA and the 38.2, and that's the 18 SMA in oil. I would like to see oil coming back to this range in order to get a nice rebound and continue higher. If it does not hold here, I would look for the 50 and the prior channel that it broke out from in order to continue higher. And if we do break the weekly high and the monthly fib, then you look for the other side. I would like to see coming in, creating a shoulder, coming back in and continuing higher, because I consider this a shoulder. This is the head of it, coming to create a shoulder and going back up, okay? So I'm not biased to any side. I like oil, and I've always been, from last year, looking at oil and saying to everybody, hey, can we get back to the 50? Can we get back to the 40? Can we get back to the 60? We hit already 60. Can we go back to where it was at $70, $80 before it fell down a couple of years? Possibility, but you have to be open mind that things are changing from oil to electrical, but electrical are still using, production from other instrument that they say, oh, this is, environmental friendly. I'm not sure all about electrical cars being environmental due to the fact they have hazardous materials similar to regular cars. I think a regular car has less hazard than an electrical car at this point due to the battery and the acid that's in it. Okay, let's go now to uh, taking a look at a couple of ETFs, NY. This is the New York Stock Exchange Composite. And what I want to do, instead of a 3 month, we can look a little tiny more. As you can see, we can keep it this way because we can see just the monthly fibs. We're going to look for a month outlook. We know that the monthly, the high and low is here. This is the 50 simple moving average, that's your 61.8. If we're going to fall down, this is the annual high. If we're going to fall back, that represent more than 1,000, 2,000 shares of the New York Stock Exchange, because this is more of an overall market view. Even if we fall back down back to the annual high in the 89 EMA, that would be good, healthy to continue higher. And if we do end up reversing at the 50 or the 61.8, be open mind, there may be change in sector rotations. Let's take a look at the XLK, that's the tech sector. Due to the tech sector in the NASDAQ 100, we can see that the NASDAQ is weaker and there's money rotation in the NASDAQ. So I do not have the fibs. I do have this major level here of this consolidation. If we lose the 89 EMA, I would look for the 116 SMA. And if this U-turns and goes back up, that's great. But keep an eye on like Amazon, Google's, Netflix's of the world, the Teslas of the world, the Microsoft, the Shopify, the PayPal's of the world. So I'm just kind of going over this XLV. That's the healthcare sector. People do need health. They need to recover. They need to, still go to see a doctor and stuff. As you can see, the healthcare sector fell back down. We are in an open cone. The 89 has to hold. If not, would be the 116, which will catch up to it, or we'll get the backside of this down channel, open cone, which is like a fan, and reverse back up, because this is the consolidation in the last 2-3 weeks on it. If I look at the IEF, this is the yield in relationship to the bond market. That's a 7-year, 10-year note. We have been falling. If interest rates are going to start spiking up and going higher, the bond value will get the par value will end up falling. The value of it will become, instead of a premium, will become at a discount, and interest rates would go up. If the Federal Reserve Board cannot control interest rates, which they should be, then we have a problem. Then we know inflation is around the corner. We can look at the TLT, which is, that's the 20-year notes, so you guys can have a better feel of it. And let's go from here to the VIX, VIX. And I want to go a little bit more in detail, not on a shorter scale, but on a longer scale. This is due to the, people worrying about inflation and interest rates. If I can go way further out, instead of a 3 months and a daily, we go to a maximum. And we go, instead of a daily, we go to monthly. It's going to look very terrible because of the ADXs, gentlemen. So what we're going to do, we're going to do it eventually on a daily chart. I'm going back all the way to 1987. That's when the VIX spiked up and we had this correction. We had the 1991, when interest rates was, at a historical high. Then we had the 1999, 2000, bubble of the tech sector. Then 2001, the Twin Tower. You can see that big spike up. We fell down, then we continued eventually, till 1997, 98. Then we recorrected. Then we went sideways in 2001, 2003, till 2009. You can see they got a spike up here in 2008, 2009. Then we fell back down in 2009 and started rallying back up, and the VIX fell back down. It stayed at a historical low. 2016, this is the Eurozone, the British, the French, exit and all that stuff that was happening in Euro. Then we had the spike in, in 2017, and due to the tariff and stuff in 2019. Then eventually in 2020, we had that little minor spike here. 2016, then we had these two spikes, and eventually the COVID-19, we spiked up, then we fell down. We still have not cleared the $38, $39 or $40 in order for the VIX to continue. Is there going to be a little volatility, little spikes up in it? Yes. Is it going to cause a reaction? If we're going to go into inflation and depression and the market gonna fall apart, the VIX has to act on it. So you have to be looking at the bond market as well as the dollar in relationship to what the VIX is doing. So what I want to do, go on a daily chart. Instead of maximizing it, we're going to go 6 month and go push OK. So you got, oops, that's the monthly. So we're going to go to daily. Oops, I did not make a correction there. And we go to daily. Here we go. As we can see, the last spike up in November, we fell back down. We went back a couple of times, because of the London issue. That was because of the London, they were talking about, the variable that was coming from Africa, the COVID-19. We went spiked up. We fell down. Then we tried to spike up because people are worried about, inflation and stuff. Is this going to continue? You have to clear 38 area, 39, and you are below the 61.8. And on the daily chart, there was a change in contract as well. There's always a little spike up to readjust the pricing of the VIX. The VIX has been depleted reverse split so many times on it. I can't remember from 2000 how many times it did a reversal split. So we still have that gap that we haven't filled 100% of it in from the February in March, February 19th through March 23rd, that spike up, we had that gap. We came back to it, we retested it in November, we touched a portion of it and bounced back up. We haven't not been able to retest that gap fill in the VIX. So that's part of the VIX. Let's go do a couple of equities and we'll make it short and simple. And I want you to stay open mind to change and what the market can give us. AAPL is in a small reset. We'll go from the daily. We'll go a little sharper so we can get a little bit more time frame on it where we can see the charts a little bit quicker because I don't want to. We have the monthly fib high and low. Apple is being in a downtrend. Keep an eye on that channel and keep an eye on the 115, 116 in case it does come back in that area for the 105 back to reverse back to the mean of that down channel here. That's Apple. Let's take a look at Amazon. Amazon, was range bound. Let's do it. Okay, this is the monthly fib high and low. In order to Amazon, this is the weekly high and low of last week and that gap here. In order to continue, we have to clear the 38, 50, 61 to continue back up to get back to the down channel, or we look for the monthly fib extensions, which are to the downside, the 123 or the minus 23 and the 38 fib on Amazon. Remember, Amazon has, always have been, whenever you look at a round number such as 3,000 or 2,900 or 2,800, you usually get a nice spike up and spike down. When they hit those levels, they usually reverse nicely. Let's take a look at Google. Oops, Google. So Google, you have the monthly fib after the earning gap. It's holding. It hasn't filled that professional gap or the earning gap from here. In order to Google, to fall apart, it has to lose the 2000 area or the 1190 to fall back to fill this partial gap, and eventually the extension would be the monthly 78% or the 100% into this consolidation before the earning to continue. I'm not saying it can go down, it can, but it doesn't have to. Let's take a look at Nflx. Oops, that's Netflix. As you can see, Netflix on the earning gap fell back, filled the gap, reversed back up, created a shoulder, coming back up, and it tried to break out on the weekly. It's still holding the 50 simple moving average. That's very important. If it does it on the daily chart and it loses the 61.8 and the 89, we will look for 100% retracement and the consolidation down into this area, which would be around the $500 for a nice reversal back up. Let's take a look at Tesla. And we've been calling Tesla, on the short side from last 2 weeks up from the 820 area. It fell down to the 800 area, and eventually this week, this is the monthly fib from high to low, and we looked at back up to the 740 area, and then we fell back down. We got to keep an eye on the 89 and the 38.2 fib, which would be like the 61. If it clears the 50, then the 61 would act as resistance, but if you break through it, we look for the backside of the 50 simple moving average and the weekly high. If it falls through here, we'll look for the 100% of the monthly fib and the monthly fib extension and the weekly, which is around the 38, 650 to 660. Okay, that's on Tesla because this was part of the consolidation before the breakout. And let me do one more for you as a favor for everyone. What I'd like to go over is not the equity itself, the volume profile in the ES and how to use it. We're going to go enter. And what I'm going to do on the daily chart, you can see the style here. What I usually do, I go to the chart setting. There's what we call volume profile from TOS. You can use in the studies, or you can go to the monkey bars. The monkey bars will give us a better understanding whether we are looking at the monthly candles or the weekly. And this is a volume profile value area high, value area low, where to the most contracts were sold, that purple area. This is usually where the open is the box This is where the close is for the month. You can look at it on a monthly basis and you can draw your fib from bottom to high so you can get the range of the 59 quarter all the way to the zero line on the monthly, which was around the 37.17 quarter. So we have to always be open mind to change in the market in relationship to where my 50 is on the chart. If my 50, I'm a little bit under it and I'm just sitting on the 38.2, do we reverse and go back to the mean, to the midpoint, or the time spent up here in order to get momentum back up? If we do fall through underneath the value area low, we continue lower and we will look for the value area low from the prior month and the POC. Usually we trade from value area low. If we stay in it, we go to the POC. If we can't, we come back from the POC down. If we break through, we look for the value area high. If we cannot break through it, we look back for the POC. And if we break up, this is high, going higher. And coming from the top, you come to the value area high and you bounce off it, that's bullish. If you go through it, you look for the POC. Then eventually, if you bounce off that, you revert, you get out of the way, or you look from the POC to the value area low, and you break through, you go further down. So you can use the volume profile, whether you use it on a daily chart or a monthly chart. It gives you a good reference where you are in relationship to where the market is. And what I'm going to do, go from here, style, I'm going to go to the timing because I'm going to change that and go on let's go to 15-day 78-minute. As you can see, this is my weekly high and low on the fib. Where is my 50% is here in relationship to the last week or the week before range, the POCs. We had couple high, then we eventually have to here. Our midpoint is here. Is this weekly value very important in that 3860 area? Yes. If we cannot sustain the 3800 and we fall through that mental number, we're going to look for the 37, 45, 37, 25 in order to reverse back up. But if we do clear the 25, then the 40, then going through the 60, we look for the other side of the mean and the consolidation of the upper 61.8, then the 38, 80, then the 3900. So be open mind. Use that profile to allow you to understand in relationship, are you inside the range from the prior day or not? Because like this was look down, look above, close higher, look down, look up, open, and fall and close lower in relationship to those two profiles. And on Friday, we looked up, came back down, looked up, and we ended up, this is the open, we ended up closing right at the bottom of the 5-day range in consolidation. So trade what you see. I hope this was helpful. And before I go, I want to show you the other 3 charts I have, and I'll go over it in detail. Here is taking a look at the overall market and getting an understanding what the S&P has done from 1983, 2003 recovery, 2009 as well. I did by accident here. We have a duplicate here by accident. I put it. Oh, I didn't know how I duplicated this line. It's already done. So, and we have the 2016 reversal from the mean. The maximum days we had drawdowns on a daily was from 18 days all the way to 283 days. So if I look at it in more detail, we have an average of 107, a drawdown of a 4% drawdown in the market, which we already have in the S&P. But do we lose that 39.59 all the way down to 37.40 of a possibility of about 13% drawdown? Yes. So what I want you to do, these are hypothetical. This was done on February 5th, the calculation. So these are real. These are hypothetical. And if I do the drawdowns up and down in relationship to what the market has given us, we know the maximum draw up is about 4,500, 4,500 on the S&P in relationship to the drawdown. But what I want to show you is the negativity of it in case we end up going south. So here is from Bloomberg talking about the 170 billion stimulus. And in the global markets, everybody's printing money to keep everybody, stay home, to do this, do that till we get 100% back and the economy running at full speed. It's like going to a football stadium when it's empty. There's no spectators to watch other than watching from your own home TV. The athletes, eventually when things go back to normal, it's going to get busy and people are going to be out. So you got to think of it that way in relationship to the drawdown and the draw up where we can be heading. And if we consider that $170 billion, 37% of it is about $62 billion, $63 billion going to go into the market to help the economy. So the stocks will eventually recover and continue higher. So here are some of the things I want you to be aware of. Protect capital. Be open to market change and trend. Be flexible with your thinking and psychology. Do not listen to people around you when they are negative. Protect your capital. Trade what the chart gives you. Don't be biased to one side. Act fast on action and reaction in the stock market. If the trend changes from being bullish to bearish or bearish to bullish, don't stay on the wrong side because that will take away from your money and your capital you'll end up using. Do not stay wrong. Okay? Money will come when you are on the right side and let the winner run. Because when it's running, don't let go of it too early because you're going to make very little and you hold on to the loser and you lose more. So this is something psychological as humans cannot let go. You're not married to a stock or an equity or a future commodity or currency or crypto or Bitcoin. You are in it to make a profit, whether it's on the short term or long term. Make sure you understand your risk and you define it. Cut your losses fast in order to sustain liquidity. And this is from JP Morgan. You can guys read it, what they think in the future. And I put here not a forecast. I'm just giving you an idea of what the S&P can do in the future. This is the short term from February 5th. That was the calculation from the prior chart. If we have lost it and we lose a 4.5% and we stay in a downtrend, the 3886 already hit. But what I did as of Friday 26, the Nasdaq, the high in the end, the S&P high was 3950.43, the SPX. So the drawdown, if I'm going to get a 13.16 average from the prior chart, I'll go back to it. So we can have a drawdown of 3430 before we can continue higher. And this is the drawdown looking at it from 3886 where the numbers are 3708 and 3729. This is the reason why I showed both scenarios from the 3886, not the 3959, and I'm showing you the maximum drawdown in case we get to the other side. Let's go back to it. Not this one. And this is historical what the drawdowns were from those years. And if I go back one more, you can see the minimum drawdowns from February 5th and the maximum drawdowns from 13.9 and 14.38. If we average this, that's where the number came from, that 13.16 and that 4.3% in the calculations. I hope this was helpful. If you like this video, give it 2 thumbs up, smash the button. And if you like to subscribe or find us, you can look us up on Solstice ATR, or you can DM me on Discord, pound capital Z, small OU, capital Z, small OU, pound 9345. Take care and be safe.